today, what the latest numbers are telling us. Hi again, it's Martin North from Digital Finance Analytics World. Latest post covering finance and problem news with a distinctively Australian flavour. Well, today we look at the latest RBA and APRA credit aggregates. It's the end of the month again. And also take a broader view of retail spending and what's happened over in the US with regard to the latest GDP outlook, because the news there is not that good. Data, of course, provides some signals as to what may happen ahead. So it's pretty important to understand what's going on. So with that introduction, let's start by looking at the RBA and APRA credit aggregates. These, of course, are released each month and relate to the overall level of credit in the economy. So firstly, the RBA figures showed that for the month of September, which is the month the report relates to, credit overall grew by 1.9% in 2020, but in 2021 it was 5.3%. Of that, housing was at 6.5%, compared with 3.3% a year ago. Personal credit was still down 5.3%, compared with 12.9% a year ago. And business credit was at 4.6%, compared with 1.9%, while broad money in September 21 was 7.9, compared with 12% a year earlier. And on a monthly basis, the total credit grew at 0.6%, which was precisely the same as last month. Housing was at 0.6%, which was the same as last month. Personal credit was exactly the same. There was a very slight uptick in business credit from 0.7% this time, 0.6% last time. And broad money was up 1.3% compared with 0.2%. That broad money indicator relates to all the additional support that was put in place through the COVID crisis more recently. So now let's look at the monthly RBA credit aggregates to September. You'll see there that housing grew by 0.63% in the month. Within that, owner-occupied housing was at 0.75%, but it's actually coming off its highs. And this is a first sign, I think, of a continued slowing of lending. The investor sector was slightly stronger at 0.31%, but it's still quite a lot lower than where it was a few months and years ago. If we look at personal credit, it's a very variable series, but it was still down 0.64% as people are repaying credit. Business credit was up 0.74%, slightly higher, but still consistently lower than where we were a few months ago. And if we then take the total aggregates of credit, up 0.59%, hardly any change from last month, and still relatively low. Whereas broad money spiked up 1.26%, simply because of all those additional support mechanisms that were put in place following the resurgence of COVID. Now, the monthly series, of course, is always very noisy, so it's always more appropriate to look at the annualized rates. That tells us more about what's really going on. And if we do that, credit for housing overall grew by 6.46 over the last year, and that's quite strong now, relative to perhaps where it was back in 2015, although the rate of growth does appear to be easing slightly. Within that, owner-occupation lending rose again, up to 8.68%. That's now very strong, probably too strong. And investor lending was at 2.42%, which continues to go higher, but is still well down from where it was in 2015. Personal credit is still lower than it was a year ago. It's down 5.31%, although the rate of decline is easing. And business credit is up 4.61% compared with a year ago, having, of course, dropped significantly early in the year and now bouncing back somewhat quicker. And we can also look at the credit aggregates Overall credit, 5.27% higher over the last 12 months, so quite a significant rise. Broad money sitting at 7.89%, which is still significantly higher than credit growth, but of course it came off its tops where it hit more than 12% following the first round of support relating to COVID. We have had more support more recently, but nowhere near as much as last time around. Now let's turn to the APRA statistics. This relates, of course, to lending by the banks, the ADIs, and the information again comes out each month and it relates to the September period. So here, overall owner-occupied growth for the banks was up 0.73% over the month. Investment lending was up 0.25%. So total lending from the banks was up 0.57% in September. If we break that down, we can see that both owner-occupied and investment lending was up. Owner-occupied loans are greater in total volume relative to the stock of investment loans. As a result of that, investment loans dropped again, now down to 34.42% of all loans. And the critical number is $1.889 trillion of mortgages outstanding. That's another new record. And you can see that since March 2019, there's been a very steady growth trend in total credit outstanding. This, of course, is deliberate strategy from the Reserve Bank. Now, it's interesting to look at the portfolio movements of individual lenders, and you can see that Commonwealth and Westpac are still leading the way. Interestingly, Westpac has reduced its share of investment loans slightly, whereas CBA and Macquarie are growing on both sides of the house. NAB focusing mostly on owner-occupied loans. And it's worth noting that ANZ is right over on the right-hand side of the chart with a fall on both investment and owner-occupied loans. They did admit in their recent release of results that they were struggling with growth in the mortgage book. They did position it as strategic. I'm less sure of that than they are, perhaps. Then if we look at some of the smaller lenders, well, ING and Bendigo were all focusing on owner-occupied loans. Suncorp, HSBC and Bank of Queensland had a mix of both investment and owner-occupied loans. And a number of other smaller players also grew just a little. So just to summarise that, we are seeing credit growth continuing to move up, but the rate of change of credit growth is easing back slightly, and that possibly will translate to lower property values ahead, bearing in mind, of course, that now there's a very live discussion about what's going to happen to interest rates. The market basically has dictated to the RBA, and they've now taken the foot off the yield curve control mechanisms they had, which means that interest rates have moved higher. That will translate into higher mortgage rates ahead. And my own suspicion is that even if there is only one small change quite soon to mortgage rates, the change of trajectory that's now signalled will be sufficient to cool the market. But we'll see. Now let's turn to Australian retail turnover figures, which the ABS reported today. They said that the retail turnover rose 1.3% in September 2021, season adjusted. That's according to the retail trade figures released by the Australian Bureau of Statistics. They said that it was the first monthly rise since May 2021, following falls of 1.7% in August and 2.7% in July, as the Delta outbreak took hold in parts of the country. Retail turnover continues to vary by state, based on whether restrictions were imposed, removed, or extended. Queensland sales rose to their highest level ever, up 5.2%, with no lockdowns in September. New South Wales also experienced a rise of 2.3%, despite having lockdowns as some restrictions were eased or lifted, but turnover for New South Wales remained 11.9% lower than at May 2021, the month before the most recent lockdown began. A full month of lockdown restrictions in Victoria and the ACT saw sales in both states continuing to fall in September, with Victoria down 2.1% to its lowest level since October 2020, and the ongoing tight restrictions in the ACT continue to limit trade as sales fell 12%. The Australian Capital Territory's September sales were 29.5% lower than the all-time high recorded only 2 months earlier. Easing restrictions have seen a rise in sales for most non-food industries, with the biggest rises, in dollar terms at least, seen in household goods at 4.3% and cafes, restaurants and takeaway food services at 5%. There were also rises in other retailing up 2.1% and clothing, footwear and personal accessory retailing up 5.9%. The only non-food industry to fall was department stores, down 0.3%. Food retailing had the largest fall, down 1.4%. This was in line with the pattern of previous post-lockdown results, which saw food retailing sales settle back down to normal levels once people had the ability to eat outside of their homes more regularly. Now, it's also worth noting that there's a new release schedule for the Retail Trade series, and so there will be additional information to be released on the 4th of November, including the quarterly retail sales data. Now, there was a US economic shock overnight because US economic growth slowed more than expected in the third quarter to the softest pace of the pandemic recovery period, as snarled up supply chains and a surge in COVID-19 cases throttled spending and investment. Gross domestic product in the US expanded at a 2% annualized rate, following a 6.7% pace in the second quarter, according to the Commerce Department's preliminary estimates. The deacceleration reflected a sharp slowdown in personal consumption, which grew at just 1.6% after a rapid 12% jump in the prior period. Shortages, transportation bottlenecks, and rising prices all were to blame. The median forecast in a Bloomberg survey of economists called for a 2.6% increase in GDP. And interestingly, the S&P 500 opened higher, while the dollar fell and Treasury yields were little changed. Excluding the trade and inventories component of GDP, final sales to private domestic purchasers, a gauge of underlying demand, rose at a 1.1% pace, and that's the slowest of the pandemic recovery. Motor vehicle output plunged and analysed 41.6% lower. Excluding auto output, GDP rose 3.5%. And services spending added 3.4 percentage points to the third quarter GDP, while goods subtracted 2.32 points. The latest data underscores how unprecedented supply chain constraints are holding back the US economy. Understaffed and short of necessary materials, producers are struggling to keep up with demand. Service providers who face similar pressures fared better than manufacturers during the quarter, despite the pickup in infections. While supply chain challenges are expected to linger well into 2022, subsiding COVID-19 infections and elevated savings should support stronger household spending in the final 3 months of the year. Looking ahead, we see a stronger pace of growth in the fourth quarter on a rebound in housing spending, albeit with downside risk from supply chain dislocations and shortages that could be a constraint for the economic expansion over coming months, said the chief US economist at High Frequency Economics. Persistent supply constraints, paired with other reopening efforts, have also driven up prices for a variety of products, spurring concerns about the breadth and duration of the recent spike in inflation. The Personal Consumption Expenditures Price Index, excluding food and energy costs, which is an inflation measure followed closely by Federal Reserve officials, remained elevated, growing an annualized 4.5% last quarter after a 6.1% jump in the prior 3 months. We don't see the raw materials or the inflation environment slowing down in any way, said 3M. Consistent with the broader market, we are experiencing inflation pressure. Next year we anticipate a more challenging inflation environment, said GE. I think the headwinds and the increased distribution costs will certainly be with us into 2022, said Kimberly-Clark Corporation. And on the cost side of the equation, we do not see any meaningful improvement until well into 2022, said the CEO of Mauritius. The risks are clear now to longer and more persistent bottlenecks and thus to higher inflation, Fed Chair Jerome Powell said last week. We now see higher inflation and the bottlenecks lasting well into next year. Inflation-adjusted business investment cooled from the rapid pace of growth seen over the past year as manufacturers struggled to fulfill orders. Non-residential fixed investment rose an annualized 1.8%. Both outlays for structures and equipment declined on an inflation-adjusted basis, while the value of intellectual property surged. The slowdown in consumer spending reflected weaker motor vehicle expenditures, which subtracted 2.39% from the GDP. Automakers have been struggling to boost production and inventory amid computer chip shortages. A wider trade deficit, reflecting record imports of foreign goods, further eroded growth. Net exports subtracted 1.14 percentage points, and residential investment also declined, and inventories added more than 2 percentage points to GDP after consecutive quarters of declines. And there was a separate report on Thursday that showed initial jobless claims fell to 281,000 last week. That's a fresh pandemic low. Continuing claims, which is a measure of ongoing benefits, dropped by 237,000 in the week ended the 16th of October, and that's the biggest decline since July. So I think we can conclude that the economic outlook in the US is still fraught with question marks with regard to the rate of inflation, and question marks also as whether growth will really bounce back or whether we continue to languish at very low levels. Of course, low growth means less likelihood of the Fed dealing with the quantitative easing or even low interest rates, whereas high inflation could mean the exact opposite. So to an extent, I think they're caught between a rock and a hard place. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.